Hello everyone, this is Tom Tanner from the Small Business Development Center. Today we're going to be talking about financial forecasting, which will be part of your budgeting that you need to do for your business plan. So all of you probably have received either a link to our guidebook or have an actual hard copy. We're going to be referring to that a little bit today, and also there's a lot of other good information in there for you. So we're going to start off with a pretty simple thing. What is the one area that small business hate to do more than anything else? They know it's important, but they still procrastinate, but wish they understood more about. Certainly, it's accounting and taxes, which are the things that we're going to kind of cover in the budgeting and the financing side of the equation today. So before we get started, I want you to take a little piece of paper out and write down an answer, and we're going to come back to the actual answer in a second here. Which one of these you think is the most important to your business? Revenue, cash flow, or profit? So write that down and we'll come back to it. We're going to cover each one individually. Start with, let's talk about revenue. So revenue is basically the money you receive from your customers and any other sources that come in. The next one we're going to talk about is cash flow. So cash flow is the movement of cash in and out of your business. And cash in basically means revenue, payment on your accounts receivables, and things like that. Cash out is going to be things like your normal expenses, taxes, et cetera, et cetera. You're also going to have some things such as cash out of things like capital purchases, which are not necessarily going to show on your profit and loss statements. So those are kind of treated a little bit different. The same thing with inventory. So that kind of gives you a show of what's coming in and what's going out. So the last thing we're going to talk about is profit. So profit is basically the financial benefit you realize when your revenue exceeds your expenses, costs, taxes, etc., which we hope you actually have profit and not a loss, but that's the profit side of your business. This is an accounting and tax term. That's all it is an accounting and tax term. They're very important, but they're accounting and tax term. So there's also non-cash items that affect your profitability. One is depreciation and amortization, which means if you buy a vehicle and you spend $20,000, you're not going to be able to take off that entire $20,000 in the first year on your profit and loss statement. It has to be depreciated, which basically means you have to take it out over a period of time. There's also things called capital loss and capital gains, which are things that would show up on your profit and loss statement that may not affect you from a cash standpoint. So now we come back to the question I asked, which one is the most important to your business? Hopefully you all selected cash flow because it is the most important. So let's talk about the next step. And these are things we're going to go into more detail when we talk about break-even analysis, is what's called fixed cost versus variable cost. So fixed costs don't change based on the amount of products that you produce or sell. So this means things like your rent, your utilities, it could be some payroll expenses and things like that. Those happen even if you don't sell a single item, you still have these costs. The next one you have to pay attention to is variable costs. Also, we call those cost of goods, which is basically if you don't incur variable costs until you actually sell something. In other words, let's just take your retail store and you're selling clothing. So you don't have an expense or you don't have a variable cost until you actually produce something and sell it to a customer. You may have had to buy inventory, which is a cash item, but it's not a variable cost because you cannot deduct that expense on that particular retail item until it's actually sold. So that gives you the fixed cost versus variable cost. So let's talk about another important thing, which is called break-even analysis. So this is a very important term and very important process that you need to go through. It's basically is used to determine at what point your business starts to make money. Pretty straightforward. If you go to page 47, I have kind of an analysis, but we're going to kind of go through an example here in a second. So basically, to figure out break-even on a really simple scale, you basically take your fixed cost, which we just talked about, which is your costs that incur that are fixed regardless if you sell stuff. And then you take your revenue per unit. So this is how much you're selling an item for. Let's just say you're you're retailing the item and sell it to customers for $50. And then you subtract your variable cost, which we just said was your cost of goods or the cost incurred to actually produce that item. And then you divide those two out, and that gives you your break even. So giving you an example, let's just look at this. Our fixed costs are $10,000. Revenue per item, so you're charging $50 for a widget. Okay, your cost of good for that widget is $25. So you basically do math, and it shows you in order to break even during this period of time that you're measuring, and the measure period depends on whatever you want to measure. Is it a month or 6 months or is it a year? But during this measurement period, you have to sell 400 units. So if we basically multiply that out by the cost per unit, you're looking at, in order to break even, you have to sell $20,000 worth of equipment. You can see why this is a very important tool that you need to do to help analyze your business. So let's talk a little bit about financial reports. So the three reports that are important to your business is going to be your profit and loss statement, your balance sheet, and your statement of cash flows. So first of all, let's talk about profit and loss, which is probably one of the more important ones that everybody's going to be looking at on a regular basis, at least hopefully you will be. So the most important thing about a profit and loss statement is it covers a period of time. In other words, it covers, January 1st to January 30th. It covers January 1st to June 30th. It covers all of 2020. So it covers you during a period of time, not just a particular date. So what it's going to include is things such as your revenue or your income coming in, your cost of goods, which we just talked about, which was your variable cost. And you subtract those out, they're going to give you your gross profit. Now you subtract your other expenses, which is a lot of them are mostly your fixed type of expenses. And whatever's left over is your net income or your profit. And net income and profit are really synonymous terms. So let me just give you an example of what one looks like. So this is a profit and loss statement. It's going to show you your income coming in. It's going to show your cost of goods. It's going to show your expenses. And then at the very bottom, it's going to show your net income. And that is basically a profit and loss statement. So now the next term we're going to go to is balance sheet. So the difference between a balance sheet and a profit and loss statement, one is a balance sheet is for a specific date. In other words, I want to know how my business is standing on December 31st, or I want to know how my standing is on June 30th. It's not covering a period of time, it's a specific date. And this report's going to show you your assets, which means things like bank accounts, accounts receivables, inventory, and things like that. It's going to show your liabilities, which are going to be things like your accounts payable. It's going to show your liabilities to banks, the bank notes, and things like that. And then what's left over is going to be your equity in your company, which is basically what you own. So the most important thing you have to remember is this little formula at the bottom, which is assets equal liabilities plus equity. Those have to match. So let's give you an example here. So this is a balance sheet. You'll see is as of December 31st, it has a specific date. So it's showing the checking account, showing savings account, accounts receivables, gives you your total current assets. You can see your furnitures and fixture, your assets are built in here. And it gives you a total of $635 for your total assets. So as you move down the page, you'll also see other things such as accounts payable, total liabilities, long-term liabilities, which are going to be loan payments. And then you're going to see your equity down here, which is what you own in the company. And you'll see that the total equities and liability of $635,033 matches your total assets. Very important thing to follow through with. All right, so the last thing is a statement of cash flows. Statement of cash flows is based on a period of time. So this is just an example. It shows what's coming in. In this particular case, this is January through December. It's showing the income coming in. It's showing the adjustments to these particular accounts, like accounts receivable, inventory. It's going to show any purchases that you made. Like this here truck, it shows minus 13. It shows you purchased a truck, so that was a negative cash. And then it's going to show you a cash at the end at the end of the period. So it goes through your process to see how the cash flows into your business and out of your business.